We always expected this to be a bit of a bumpy road, right? If we're talking about the Fed's tightening cycle. What do you make of yesterday's sell-off? Was this just a bump in the road, or is this a sign of maybe some more things to come?
Thanks for having me on. Yes, certainly a bump in the road on the way to so-called immaculate disinflation. So that January CPI report was a bit of a shocker. And, there's a measure that the Fed pays attention to that they call super core inflation. So essentially, that's just tracking non-energy services, excluding housing or shelter. And that number rose pretty rapidly, depending on which measure you look at, 7/10 or even 9/10 of a percentage point. So that is really not what the Fed wants to see. And on the back of a very strong non-farm payroll report just a few weeks ago, aided in pushing those rate cut expectations backward. And, we just heard Fed Chair Powell recently say March is probably not going to be the meeting for the first rate cut. And now you can see that markets have even priced out the cut in May or have gone, very far in doing so. And with equity markets having run like they've run late last year into this year, it doesn't take much if you disrupt the narrative to see a big dump like we did yesterday. So not super surprising in that context.
With that said, we are just talking about 1 month. January typically a little more volatile than some others. How do we put this in the context of the overall timeline for that rate cut? Does it change a whole lot for you?
Yeah, I mean, my sense was that the Fed was going to be pushing back on the expectations, both in terms of timing and magnitude for rate cuts. Within their framework, what they're really looking at in terms of, where future inflation is going is labor market slack. We haven't really seen much, if any, loosening recently there. In financial conditions, which have eased pretty dramatically on the back of this risk asset rally. So our sense was that the Fed was going to be pushing back anyway. So hotter or stronger data is just going to reinforce that. There's a risk to the business cycle in doing so. I mean, the Fed is very focused on realized or reported inflation. It does tend to lag the business cycle. And so there's a risk here that pushing back too far, the Fed then starts the process and the economy's already started to weaken pretty significantly. And then if they're behind the curve, that's when recessions tend to happen. So no one's really focused on that risk right now. The focus seems to be fears of overheating. But things could change fairly quickly. And I think we need to be aware of that given where equity valuations are. We're just absolutely priced for perfection here. So whether it's the business cycle risk on one tail or inflation and rate cutting risk on the other side, it's worth considering risks that are not priced into the market at this point. But our sense is that don't panic over one inflation reading. The Fed is more focused on the PCE inflation, which comes from a separate report. That's looked much better over the last 6-7 months, and we actually see the largest gap between core inflation readings from the CPI versus the PCE. A gap about 3 times the historical norm there. So, I wouldn't go too crazy with the interpretation on the CPI report, but it certainly, fed the higher for longer narrative in the last couple of days.
Yeah, with that said, the reaction yesterday to that CPI report points to just how jittery investors are right now on any indication of inflation, not necessarily pulling back at the rate that's broadly expected. What happens if the retail sales number tomorrow comes in stronger than expected? We likely to see a bigger move again in the markets?
For sure. I mean, just before we jumped on, I was looking at 3-year Fed policy rate expectations, and they've lifted by about 70 basis points since late last year. And that really traces out the move higher in the 10-year yield that you guys were just talking about. So if the retail sales figures come in hot, I mean, we're looking for a softer report, but they've surprised to the upside in the last few releases. If they come in hot on the back of this strong January inflation reading and the payrolls report that blew away expectations, then that just continues to feed this higher for longer narrative a further pricing out of the timing of rate cuts on the part of the Fed. Now you have some people talking about no rate cuts, the Fed potentially even raising rates again. So I think we're quite a ways away from that, but we'd be pushing further in the higher for longer direction if we get a hot retail sales report tomorrow, and probably more equity market volatility with these high valuations. The expectations are just incredibly high, especially for the leading sectors of the S&P 500 like tech and consumer discretionary. So it's not going to take much in terms of disrupting the narrative to see volatility here, in my opinion.
Yeah, no question about that. Michael, it's good to get your perspective today. Michael Darda, Roth MKM Chief Economist and Macro Strategist. Good to have you on.
Thanks for having me.